Here's a recent trade I just closed with a massive gain. How did I predict this chart was about to explode upward? Because of one specific candlestick pattern that most traders completely misunderstand. In this video, I'm going to reveal the 13 candlestick patterns that I use every single day to read charts like a professional and predict market direction with surgical precision. And if you stick around to the end, I'll share a powerful bonus tip that will make spotting these patterns incredibly easy, even if you can't memorize them all. Before we dive into these crucial patterns, let me show you why candlestick charts are so much more important than regular line charts. Most beginner traders ask me this question all the time. Why can't I just use line charts? Wouldn't that be simpler? Here's what they don't understand. Line charts only give you one piece of information, the closing price for each period. That's like trying to drive a car with your eyes closed. But candlestick charts, they reveal 4 critical pieces of market intelligence that can make or break your trades. Let me break this down for you using a real example. On the left, we have the basic line chart, and on the right, the candlestick chart. Notice how both charts follow a similar pattern, but watch what happens when we dig deeper into the data. The line chart shows us that price hit a support level and bounced. That's all we know. But when we switch to the candlestick chart, a completely different story unfolds. The candlestick reveals that price actually broke below the support level at one point, as shown by that long lower wick, before buyers stepped in and drove it back up to close at the key level. This is absolutely crucial information that line chart traders miss completely. These hidden details can tell us exactly where price might go next, and that's why professional traders always use candlesticks. Every single candlestick tells a story about the battle between buyers and sellers. Green candles form when the closing price is above the opening price, showing that buyers dominated sellers during that period. Red candles are the exact opposite. Sellers overpowered buyers, pushing the closing price below the opening. But here's where it gets really interesting. The size and shape of these candles reveals the intensity of this battle. A candlestick has 2 main components, the body and the wicks, also called shadows. Large bodies tell us about dominance. When you see a green candle with a massive body, buyers weren't just in control, they completely overwhelmed sellers with minimal resistance. The price opened lower and buyers pushed it up significantly before the candle closed. It's the same story with large red bodies, but with sellers in complete command. Small bodies reveal a different type of market, one where neither side could gain decisive control. Even though buyers might have won slightly, sellers put up strong resistance, keeping the price movement limited. The wicks are where things get really fascinating. A long lower wick shows that sellers initially pushed price down hard, but buyers fought back with such force that they drove price significantly higher before the candle closed. This indicates strong buying pressure at that level. A long upper wick tells the opposite story. Buyers tried to push price up, but sellers rejected that move with authority and drove price back down considerably. This shows powerful selling pressure. When you see a candle with a small body and equal wicks, that's the market telling you that neither buyers nor sellers could establish control. It's like watching a tug of war where both teams are perfectly matched. Now let me show you the 13 candlestick patterns that actually work and have consistently made me money throughout my trading career. I hope you guys will get some value out of this and will learn something new. If you do, I would really appreciate it if you would take 5 seconds to like this video and write in the comments where you're trading from. The first pattern I want to show you is the breakout candle. This is one of the most explosive patterns you'll ever see on a chart. The breakout candle pattern occurs when you have multiple small candles with tiny bodies consolidating sideways, followed by one massive candle that breaks out of that consolidation. This pattern shows that price was stuck in indecision with no clear direction until one side, either buyers or sellers, gained enough strength to push price significantly in their favor. The series of small candles represents consolidation, while the large candle is your breakout signal. For this to be valid, you need at least 3 consolidation candles, but the more you have, the more powerful the eventual breakout becomes. The bullish breakout pattern shows a large green candle breaking upward, while the bearish pattern shows a large red candle breaking downward. The color of the consolidation candles doesn't matter. What matters is their small size. When you see this setup, you can enter a position in the direction of the breakout candle at its close, with your stop loss placed at the opening price of the breakout candle. My absolute favorite and most used candlestick pattern I trade with is the engulfing candle. This pattern consists of 2 candles, a smaller first candle followed by a massive candle of the opposite color. The key requirement is that the second candle's body must completely swallow the first candle's body. There are 2 types of engulfing patterns. The bullish engulfing appears when a small red candle is followed by a large green candle that completely engulfs it. The bearish engulfing is the opposite, a small green candle followed by a large red candle. Here's a perfect example of how powerful this pattern can be. Notice how price approaches this strong support level where it had bounced multiple times before. We can expect another bounce, but we need confirmation before entering. That's exactly when this incredible bullish engulfing candle forms right at the support level, completely consuming the previous red candle. This demonstrates incredibly strong buying momentum, and we can be highly confident the price will continue moving upward from this level. We can take a long position at the closing price of the large green candle, with our stop loss positioned at the bottom wick of that engulfing candle. The bigger the engulfing candle, the higher the probability of a successful reversal. The third pattern I want to show you is the pin bar. The pin bar is a single candlestick pattern that can give you laser precise entry points. This pattern features a small body with one dramatically long wick pointing in one direction. A bullish pin bar has a small body with a long lower wick, showing that sellers initially drove price down hard, but buyers rejected that move and pushed price back up before the close. This demonstrates that buyers are gaining control at that level. The bearish pin shows the opposite story. Buyers pushed price up, but sellers stepped in with such force that they drove price significantly lower before the candle closed. Here's the crucial part that most traders get wrong. I never enter immediately when I see a pin bar. Instead, I wait for additional confirmation. For a bullish pin bar, I want to see another green candle form, confirming the upward momentum. Only then do I take a buy position, with my stop loss placed at the bottom of the pin bar's long wick. Moving on to pattern number 4. But first, I want to take a moment to thank our amazing community. We went through all the comments under our last video about Richard Dennis, and we selected the most useful one. To show our appreciation, we're gifting that viewer 1 free month of Flux charts. Please reach out to our email to claim your free subscription. Now, if you haven't heard about Flux charts yet, this is the platform I personally use every single day for my trades, and honestly, it completely changed how I trade. Flux has this insane feature where you can run screeners on up to 15 tickers and timeframes at once. Yes, 15. So instead of flipping through chart after chart, the screener just tells me exactly where my setups are happening. It saves me so much time. They also have backtesting tools that let you build totally custom strategies and test them against years of market data in seconds, so you know if a strategy actually works before risking a single dollar. And here's the best part, 90% of their indicators are completely free. That's wild, because most platforms don't even give you one good indicator for free. On top of that, they host daily live trading classes, teaching not just how to use their tools, but how to build strategies, manage risk, and sharpen your trading mindset. If you want to try them out, click the link in my description, and use the code TradingNotes15 at checkout for 15% off. Alright, let's get back to the video. The multiple wick pattern. This is one of my personal favorites because it usually holds true on charts and is surprisingly simple to identify. The multiple candlestick pattern occurs when you have 3 or more candles with wicks pointing in the same direction. I love pairing this pattern with support and resistance levels. When you see multiple candles with downward wicks forming exactly at a support level, it tells you that sellers keep trying to break that support, but buyers are fighting them off and winning every single time. This confirms that the support is legitimate and price has a strong chance of bouncing upward. The more candles with wicks in the same direction, the better the probability that price will respect that pattern. At resistance levels, multiple candles with upward wicks show that buyers are trying to push higher, but sellers keep rejecting those attempts, making it a great short entry opportunity. Next, we have the 3-bar continuation pattern. This is one of my secret weapons for catching trending moves that most traders completely miss. The 3-bar continuation pattern consists of 3 consecutive candles that must form in a specific sequence. The first candle should be large with a substantial body, bigger than the average candles around it. The second candle is a smaller, opposite colored candle that ideally shouldn't exceed half the size of the first candle's body. The third candle should be another large candle that closes higher than the second candle's close. The bullish version has large green candles as the first and third, with a small red candle in the middle. The bearish version uses large red candles with a small green candle in between. This pattern is absolutely incredible for continuation trades. When you see this formation during an existing trend, it signals that the trend is likely to continue with renewed strength. For a bullish pattern, you can enter a long position at the close of the third candle, with your stop loss at the bottom wick of the second candle. The sixth pattern is the 3-bar reversal. While the 3-bar continuation helps you ride existing trends, the 3-bar reversal pattern helps you catch trend changes before they happen. This setup consists of 3 candles in sequence. The first candle is large with a nearly full body. The second candle is smaller with the same color and a small body. And the third candle is a large, full-bodied candle of the opposite color. Here's what makes this pattern so reliable. The size of the third candle determines the success rate. If the third candle's body is equal to or larger than the first candle, you're looking at a high probability reversal signal. If it's smaller, the signal is weaker. The bullish 3-bar reversal shows 2 red candles followed by a large green candle. The bearish version shows 2 green candles followed by a large red candle. During a downtrend, when you spot a bullish 3-bar reversal, you can enter a buy position at the close of the third candle, with your stop loss at the lows of the second candle. Let me show you pattern number 7. The momentum candle. The momentum candle is one of the easiest patterns to spot because of its sheer size. This pattern consists of a single candle that's 2 or 3 times bigger than the previous candles before it. This candle is incredibly powerful because most of the time after it appears, price continues moving in that same direction. The most effective way to use this pattern is in choppy, sideways markets where price has been moving without clear direction. Here's why this works so well. When markets are moving sideways, there are tons of traders stuck in losing positions, with stop losses clustered around key levels. When a sudden momentum candle breaks through these levels, all those stop losses get triggered, adding massive fuel to the price movement and creating a cascade effect that pushes price even further in that direction. Next, we have the Doji candle. The Doji candle is one of the most important reversal indicators you need to understand. This candlestick has an extremely thin body with wicks extending from both sides, representing market uncertainty and indecision. What makes this candle so powerful is that it shows neither buyers nor sellers could gain control during that period. When there's uncertainty in the market, price often reverses in the opposite direction of the previous trend. There are several variations of the doji: the regular doji, the long-legged doji with larger wicks, the dragonfly with a small body and big bottom wick, and the gravestone with a small body and large upper wick. All of these signal the same thing, a potential price reversal. Here's my strategy for trading doji candles. After I spot one, I wait for 2 or more candles of the same color to confirm the reversal direction. For example, if I see a doji during a downtrend followed by 2 green candles moving upward, that confirms the reversal and gives me confidence to enter a long position. Pattern number 9 is the hammer. The hammer is usually a candle that has a decent sized body and a long lower wick. What this candle tells us is that sellers managed to push the price way down, but then buyers absorbed all that selling pressure and drove the price back up significantly before the close. This is typically an extremely bullish sign and shows us that buyers are gaining strength at that level. Next up is pattern number 10, which is the shrinking candle pattern. This pattern is like watching a trend slowly lose its power before completely reversing direction. The shrinking candle pattern consists of at least 3 consecutive candles of the same color, each getting progressively smaller, followed by a large candle of the opposite color. This formation shows that the previous trend is gradually losing momentum, as indicated by the shrinking candles. Then the large opposite color candle appears, confirming that the other side has taken control and the reversal is underway. The size of the 4th candle is absolutely critical for success rate. Larger candles indicate stronger momentum and higher probability of reversal. I recommend looking for patterns where the 4th candle closes above the 2nd candle for maximum effectiveness. For a bullish shrinking pattern, you'll see 3 red candles getting smaller, followed by a large green candle. You can enter a long position at the close of the green candle with your stop loss below the previous candle's low. Pattern number 11 is the Marubozu. The Marubozu is a powerful trend continuation signal. The bullish Marubozu is a large green candle with no wicks whatsoever, basically just a big green rectangle. This means the opening price was the exact same as the lowest price of that period, and the closing price was identical to the highest price. This candle shows that buyers had complete control from the very beginning to the very end of that trading period. There was no resistance from sellers at all. This is typically seen in the middle of strong trends, confirming that the trend will continue moving in that direction. The bearish Marubozu works the same way but in reverse. A large red candle with no wicks, showing sellers had absolute dominance throughout the entire period. When you see a Marubozu candle in the middle of an existing trend, it's usually a strong signal that the trend will continue with even more momentum. Moving on to pattern number 12, the shooting star. The shooting star works just like the hammer, but it has the long wick on the opposite side, at the top. This candle shows that buyers initially pushed price up hard, but sellers stepped in and rejected that move, driving price back down considerably before the close. You should trade this exactly like the hammer, but in reverse. When you see a shooting star, it's usually a strong indication that price will start reversing downward. The last and final pattern I want to talk about is the tweezer pattern. This formation consists of 2 consecutive candlesticks, a red candle followed by a green candle, both having similar wicks pointing in the same direction. If you see this pair with both candles having wicks on the bottom, you can have a pretty strong indication that the chart is about to move upwards. Let me show you how this works. Notice how price approaches this support level where we see a red candle with a long wick at the bottom, right at the support. Then we get a green candle that also has a wick heading downwards at the exact same level. This tells us that price is respecting this support area and is now building momentum to move upward. This creates an excellent buying opportunity. The bearish tweezer works in the exact opposite way. You want to see a green candlestick followed by a red candlestick, both having wicks pointing upward at the top. When you spot this pattern at resistance levels, it's usually a strong signal that price is about to reverse downward. Now here's where most traders fail. They try to trade these patterns in isolation, but if you want to achieve consistent profits, you need to combine these patterns with other forms of analysis. Let me show you the exact advanced strategy I use to achieve strong returns year after year. First, you want to focus on higher time frames. Any time frame at or above the 1 hour chart works much better. Candlestick patterns are significantly less effective on lower time frames, so this is absolutely crucial for your success. The first step is identifying a key level on your chart. These could be support and resistance levels, dynamic key levels, trend lines, Fibonacci levels, or other significant price areas. For this example, let's focus on support and resistance levels and trend lines. Look at this chart where price has formed a clear downward trend and bounced twice at a specific area, creating a solid support level. Now we wait for price to interact with this level once again. At this third approach, we're expecting another bounce, but we need confirmation from a candlestick pattern that supports our bullish bias. Notice how we get a large red candle, followed by a smaller red candle, then a large green candle that closes above the body of the first candle. This matches perfectly with our bullish 3-bar reversal pattern, suggesting that price will reverse to the upside. You can enter a buy position at the high of the third candle, place your stop loss at the low of the second candle, and set your take profit target at twice the size of your stop loss. As you can see, price moved up exactly as predicted and hit our profit target. Here's another powerful example using confluence levels. In this chart, price is in a downward trend and has formed a support turned resistance level. This happens when price initially respected a level as support, but then broke below it and is now approaching it again from underneath, making it a resistance level. But notice something even more significant. Price has also created 2 lower highs, forming a strong downtrend line. The area where this trend line intersects with the resistance level is called a confluence level, an area where multiple key levels meet. Price is much more likely to reverse at confluence levels because you have multiple technical factors working together. When price reaches this confluence zone, we see 3 green candles each getting progressively smaller, followed by a large red candle. This shrinking candle pattern shows that buying pressure was fading as price approached our confluence level, giving sellers the perfect opportunity to take control. This setup provides an excellent short entry opportunity. You can place your stop loss above the high of the previous candle and set your profit target at twice the size of your stop loss. The price moved down exactly as anticipated and reached our profit target shortly after entry. Now, here's that bonus tip I promised for everyone who made it to the end of this video. This is my way of saying thanks for watching all the way through. Even though I recommend trying to memorize these patterns so you can spot them instantly, I completely understand that it can be challenging to remember what they look like, especially when you're starting out. Well, here's something that will make your life so much easier. There's actually a way to have your chart tell you exactly where these candlestick patterns occur, which makes spotting them incredibly simple and you don't even have to memorize every single one. Here's how you do it. Just go to Trading View, click on the Indicators tab at the top, and then type in whatever candlestick pattern you're looking for. So for this example, let's search for bullish engulfing. Simply click on it, and Trading View will automatically mark every single spot on your chart where a bullish engulfing candle appears. This makes it extremely easy to identify these patterns without having to strain your eyes looking for them. But here's where it gets even better. You can add multiple candlestick pattern indicators to your chart at the same time. So you can have bullish engulfing, bearish engulfing, doji patterns, and hammer patterns all showing up automatically on the same chart. This way you can spot any of these high probability setups the moment they appear. This technique is incredibly powerful because it removes the guesswork and helps you focus on what really matters, confirming the setup with proper risk management and key level analysis. Instead of spending time hunting for patterns, you can spend your energy on executing perfect entries and exits. Thanks for watching, and see you guys in the next video.